Imagine you're holding a checkbook with enough zeros to rebuild a country, or to chain it to debt so long the grandchildren are still paying. One signature, one set of conditions. One technical assistance mission that arrives with smiles, spreadsheets, and a quiet understanding. Money always comes with a map of who gets to decide what development means. And that checkbook doesn't sit in a villain's lair, a TIA. It sits inside a plane. Bureaucratic building a short walk from the White House, close enough to smell the politics, far enough to claim neutrality. This isn't Wall Street. It's not the Pentagon. It's something stranger. An institution that speaks the language of poverty reduction, but moves like a bond issuer and thinks like a post-war empire. This is the World Bank. On the brochure, it's a noble machine built to end extreme poverty. In reality, the World Bank is a historical compromise, a Cold War artifact with a modern balance sheet. Sometimes it builds miracles, power grids, vaccines, schools, roads that connect farms to markets. Sometimes it builds disasters, debts that outlive regimes, megaprojects that bury villages, reforms that look clean in reports and feel like starvation on the ground. So forget the PR. Tonight, we're pulling the curtain back on the mechanics. Not what the World Bank says it is, what it actually does. To understand it, you have to go back to a moment when the world was still smoking. 1944. The war isn't even over yet. And the leaders of the winning side are already planning the next battlefield, the economy. Because everyone with a pulse knows the hard truth: bombs end wars, but recessions create the next one. You can defeat an army. You can't defeat desperation. So 730 delegates from 44 nations gather at a hotel in Bretton Woods, New Hampshire. The official mood is cooperation, reconstruction, peace. The real mood is a high-stakes poker game to decide who holds the steering wheel of the 20th century. On one side is John Maynard Keynes' brilliant, elegant British proposing a global currency and a system that punishes not only deficits, but also massive trade surpluses. A world where the strong can't quietly choke the weak by hoarding demand. On the other side is Harry Dexter White, representing the United States, practical, sharp, and holding the winning hand. America controls the gold. And in global finance, the oldest rule is still the truest one. He who holds the reserves writes the rules. Keynes' dream dies in committee. The system that emerges is pegged to the US dollar, backed by American gold, and enforced by institutions designed quietly, efficiently to ensure that the next century runs through Washington. Two institutions are born in that room like twin engines bolted to the same aircraft: the IMF for short-term crises, and the IBRD, the International Bank for Reconstruction and Development. That second one becomes what most people call the World Bank. But here's the first twist most people miss. This is not the United Nations. It isn't one country, one vote. That would be diplomacy. This is finance. And finance doesn't do equality. Finance does shares. The World Bank is structured like a corporation. Voting power is tied to capital subscriptions, how much money you commit. And the United States, from day one, is the largest shareholder. Historically, that has meant something like 16 to 17% of the voting power. Now, if you're listening casually, that sounds like a minority. Not enough to control everything. Not enough to dictate terms. But the World Bank isn't designed for majority rule. It's designed for veto power, disguised as collaboration. Major decisions require an 85% supermajority. So do the math. If you need 85% to pass something and one shareholder holds 17%, that shareholder doesn't need to win votes. They just need to say no. The result is quiet, mathematical dominance. The U.S. has a structural veto over major reforms, allocations, and by tradition leadership. No speeches, no tanks, just arithmetic. Now, to be fair, there is a steelman case for this. In 1944, the U.S. is the only major economy not reduced to rubble. It has the capital, it has the capacity. It's underwriting reconstruction. If you're fronting the money to rebuild railways and power grids, you expect influence over how the money is used. Skin in the game, as bankers like to say. And in the early years, it works. Europe rebuilds, infrastructure rises from ash. The post-war miracle happens. But then the story pivots. By the 1960s, Europe is standing again. The reconstruction mission is running out of customers. So the bank turns its gaze to the global south. Newly independent nations in Africa and Asia countries trying to build institutions while the ink on their borders is still wet. The pitch is seductive. We rebuilt France. We can rebuild you. But rebuilding France is an engineering problem. Rebuilding a new state with weak tax systems, fragile borders, and political volatility is a governance problem. And here's the paradox: the World Bank's charter says it must not interfere in politics. So it tries to solve political problems with financial tools. It treats power like a technical detail. It turns history into a spreadsheet line item. And that decision, more than any slogan, sets the tone for the next 80 years. Because the World Bank is not one bank. It's a family, multiple institutions stitched together. But for now, you only need to understand the two personalities that live inside the same suit. The IBRD lends to middle-income countries: Brazil, India, Indonesia, countries that can repay. It raises money by issuing bonds. It cares deeply about credit ratings, repayment, and credibility with investors. And then there's the IDA, created later as the soft arm for the poorest countries, those too fragile to borrow on normal terms. IDA money is concessional, near zero interest, long maturities, sometimes effectively grants, and it relies on periodic replenishments from rich donor nations. This creates a split personality that defines everything. One arm must look pristine to bond markets. The other arm is supposed to reach the people who can't pay. Sometimes those missions align. Often they collide. Because when you build an institution that talks like a charity but funds itself like a bank, you get a machine that can do extraordinary good and extraordinary harm depending on who it chooses to protect when the pressure rises. And pressure always rises. Because once you understand the World Bank's origin, Bretton Woods, voting shares, the American veto, start to see the uncomfortable pattern. The bank isn't merely a development agency. It is, in many eras, a financial instrument of the world order that created it. And the moment you mix moral language with geopolitical incentives, the people at the bottom become the easiest variable to adjust. Now that we've built the foundation, the post-war architecture, the voting power, the split personality, there's a bigger secret we need to unpack next. The one most people never understand. Where does the World Bank actually get its money? Because it's not a giant vault of tax dollars. It's something much more modern and much more dangerous. In the next section, we're going into the bank's real engine, the bond market hustle, how it turns promises into power. Here's the biggest misconception about the World Bank, one that even educated people repeat at dinner. Parties like it's obvious. They think the World Bank is funded mainly by governments writing checks. They imagine a giant vault in Washington where the US, Germany, Japan, and Britain pour tax money into a development faucet, and the bank just distributes it. That mental picture is comforting because it's simple. It's also wrong. The World Bank, specifically its core lending arm, the IBRDS, not a charity living off donations. It's closer to a financial engineer with a halo. Its real superpower is not generosity, it's leverage. The IBRD is arguably one of the most effective financial magicians ever created by humans. It takes a relatively small base of government capital and turns it into a lending machine that can move sums large enough to reshape nations. And it does it with a trick that would make a hedge fund manager smile. When a country joins the World Bank, it subscribes to capital like buying shares in a club. But here's the genius. Most of that subscription is not paid in cash. Only a small portion is paid in capital, historically, often under 10%. Real money. The rest is something far more powerful: callable capital. Callable capital is not cash sitting in an account. It's a promise. A legal IOU from member governments, especially the rich ones, saying, if the World Bank ever can't pay its debts, we will step in. In other words, the bank doesn't sit on a mountain of money. It sits on a mountain of credible guarantees. And in finance, a credible guarantee can be more valuable than cash. Cash runs out. Reputation scales. So the bank takes that guarantee and walks into the real temple of global power, the bond market. It issues World Bank bonds, debt securities, purchased by pension funds, insurance companies, sovereign wealth funds. The people whose entire existence depends on one religion: safety. If you're a pension manager in Tokyo or Amsterdam, you don't want excitement. You want a place to park billions with near-zero default risk. A World Bank bond looks close to sovereign debt because behind it are the balance sheets of major governments and the political reality that letting the World Bank fail would be a global humiliation. So the market buys. And because the market buys, the World Bank borrows at very low interest rates, sometimes almost as low as the US government itself. Then it turns around and lends that money to countries at slightly higher rates. That slightly is everything. Borrow at 3%, lend at 4%. That spread, one small percentage point, funds the institution's operations, builds its reserves, pays for the armies of economists, consultants, procurement experts, safeguard compliance teams, and the endless reports that get shipped like paperwork confetti across the developing world. This is why the IBRD has often been profitable. It's not a handout machine, it's a leverage machine. And if you're listening closely, you can already hear the danger. Because the method used to get money dictates how you are allowed to spend it. If you rely on donations, you think like a humanitarian. If you rely on bond markets, you start thinking like a banker. To keep that precious high credit rating, the World Bank must reassure investors. Loans will be repaid, portfolios will remain safe, defaults will not spiral. And that creates a quiet, perverse incentive. The World Bank, structurally, prefers clients who can pay. It prefers middle-income countries with stable repayment histories. It prefers the bankable over the desperate. This is how you end up with a surreal reality that shocks people the first time they learn it, for years. The World Bank lent enormous sums to countries like China not because China was poor, but because China was reliable, a strong borrower, a client that kept the machine running smoothly. Meanwhile, the poorest nations, the ones that need help the most often, fall to the IDA, the concessionary arm, because they can't be approached as normal credit risks. And even inside the bank, the consequences get sharper. The bond market logic pushes lending toward projects with measurable cash flows. A toll road has revenue. A port has fees. A power plant sells electricity. A dam produces a clear output that can be turned into repayment capacity. But what about basic literacy? What about primary health clinics? What about maternal survival? Literate 6-year-old does not send a check to the World Bank. The payoff is real, but it's long-term, indirect, politically messy, and hard to monetize. So historically, the bank loved concrete. Big, visible, transformational projects. Dams, highways, grids, things that make excellent photos in annual reports and even better repayment narratives for bondholders. And yes, infrastructure matters. Without power and roads, economies stagnate. Hospitals don't run on moral intention. Refrigerated vaccines don't travel across muddy villages on poetry. But here's the brutal part, the part that never appears on the glossy brochures. Concrete doesn't land gently. A dam is not just megawatts. It's often the flooding of valleys, the displacement of communities, the rewriting of local geography from the top down. A highway is not just connectivity. It's land acquisition, relocation, disruption, winners and losers chosen by the route of a line on a map. So the World Bank becomes a machine that can scale money. But scaling money means scaling consequences. And the people who pay the most immediate price are often the ones with the least voice. Rural communities, indigenous groups, people without lawyers, people without political access, people who don't speak the language used in the meetings where their fate is decided. Which exposes the bank's deepest contradiction. It claims to serve the poor, yet its biggest accountability pressure often points upward to financial markets and major shareholders. If bond traders get nervous, lending shrinks, ratings wobble, the machine tightens. If villagers get displaced, it becomes a safeguard incident, an internal compliance file, a paragraph in a report. The method of funding becomes the method of governance. And that leads us to the next layer of the story, the one where this financial machine stops being neutral capital and becomes ideology. Because once the bank can move money at scale, the next question is simple. What does it demand in exchange? In the 1980s, it demanded something huge. Not collateral, not assets, not gold. It demanded policy. It demanded a country reshape its economy in the image of the institutions that controlled the capital. In the next section, we enter the era when the World Bank and the IMF became surgeons, sometimes saving patients, sometimes cutting out organs. We're going into the Washington Consensus. And what happens when help comes with shock therapy? If the bond market hustle explains how the World Bank gets its money, the 1980s explain how it used its leverage. And this is where the story gets uncomfortable, because the World Bank doesn't just fund projects. It shapes policy. To understand how, we need to step into a decade of neon lights, Wall Street bravado, and global financial panic. The 1970s had been easy money. Developing countries borrowed heavily while interest rates were low. Petrodollars were flooding the system. Banks were eager to lend. Governments in Latin America and Africa took on loans to industrialize, subsidize food and fuel, and build ambitious public sectors. Then, in 1979, everything changed. The U.S. Federal Reserve, under Paul Volcker, raised interest rates aggressively to crush American inflation. A T worked eventually. But for countries that had borrowed in dollars, it was catastrophic. Interest payments exploded overnight. Mexico defaulted in 1982. Brazil trembled. Argentina spiraled. The Third World Debt Crisis was born. Governments suddenly couldn't pay their debts. They couldn't import food. They couldn't service loans to Wall Street or the World Bank. Enter the rescue package. But it wasn't a blank check. The World Bank and the IMF stepped in with something called structural adjustment programs. SAP's name sounds clinical, technical, harmless. In reality, it was economic shock therapy. The deal was simple. We will lend you the money to avoid collapse, but you must restructure your entire economy. This policy bundle became known as the Washington Consensus, a term coined to describe the set of reforms favored by Washington-based institutions. It included fiscal discipline, privatization, deregulation, trade liberalization, currency devaluation, and cutting subsidies. On paper, it made sense. Many developing economies were inefficient. State-owned enterprises were bloated and corrupt. Governments were printing money recklessly. Inflation was rampant. In some cases, hyperinflation reached thousands of %. The World Bank was not wrong that reform was needed, but reform is not the same as uniformity. And this is where the tragedy unfolds. The bank applied a largely one-size-fits-all model across vastly different political, cultural, and institutional environments. Imagine prescribing the same treatment for a broken arm, pneumonia, and malnutrition. Cut government spending. Open markets immediately. Sell state assets quickly. Remove subsidies now. No sequencing. No institutional ramp-up. No political cushioning. Take agriculture in parts of Africa. For decades, governments had subsidized fertilizer and inputs to small farmers. Economists at the bank argued these subsidies distorted markets. The private sector, they said, would step in once subsidies were removed. So governments cut them. But in remote rural areas with poor infrastructure and low profit margins, private distributors didn't appear. Fertilizer prices spiked. Yields dropped. Food insecurity rose. In some regions, hunger worsened. On paper, the policy removed distortion. On the ground, it removed survival. Then there's Latin America, the so-called lost decade, between 1980 and 1990. Per capita income in the region fell significantly. Poverty increased. Social spending shrank under austerity measures. Privatization often happened quickly, sometimes transparently, sometimes not. In certain countries, public assets were sold below value, benefiting elites with political connections. Inequality widened. The bank would argue that reforms eventually laid groundwork for future stability, and, in some cases, that is true. Inflation came down. Markets stabilized. Growth resumed in the 1990s in parts of the region, but the cost was immense. Entire generations experienced stagnation. And perhaps the most striking contrast was East Asia. Countries like South Korea and China did not follow the Washington Consensus formula exactly. They protected industries strategically. They sequenced liberalization carefully. They maintained strong state roles in guiding development before opening fully to global competition. The result? They became industrial powerhouses. Meanwhile, many countries that implemented the textbook reforms rigidly struggled for decades. The lesson was clear. Economics is not physics. A policy that works in one country may fail catastrophically in another. Institutions matter. Governance capacity matters. Political timing matters. But there's another layer here, one less discussed. Structural adjustment programs were not just about economics, they were about power. When a country is bankrupt and desperate, its bargaining position collapses. Conditional lending means policy is no longer solely decided by elected officials. It becomes negotiated between finance ministers and external technocrats. The bank would argue it was promoting sound economics. Critics argued it was imposing ideology. And sometimes it was both. Because there is a brutal logic in international finance. When you owe money, you lose autonomy. The Washington Consensus turned debt into leverage, not tanks, not colonial governors. Contracts. It was a new form of influence, one written in economic language rather than imperial decree. And yet, we must be careful not to reduce the story to villain and victim. Many governments embraced reforms willingly. Some reforms worked. Inflation control, fiscal discipline, and market reforms did improve outcomes in certain contexts. The problem wasn't always the direction, it was the speed, the rigidity, the assumption that markets alone could replace fragile institutions overnight. In some countries, rapid trade liberalization exposed infant industries to global competition before they were ready. It was like placing a toddler into a heavyweight boxing ring and calling it free market competition. The Washington Consensus revealed something fundamental about the World Bank. It is not neutral. It carries the intellectual DNA of the countries that dominate its voting structure. It reflects the prevailing economic philosophy of its largest shareholders. And in the 1980s and 1990s, that philosophy was neoliberal reform. The consequences were uneven, some stabilizing, some devastating. But the pattern was consistent. When crises hit, the bank didn't just lend money, it rewrote playbooks. And rewriting playbooks from Washington often meant rewriting lives in Lagos, Lima, or La Paz. The 1980s left scars. And the bank learned slowly, reluctantly, that pure macroeconomic prescriptions were not enough. So it pivoted again, away from pure shock therapy, toward something more tangible, more visible, more concrete. If structural adjustment was software, the next era would be hardware. Mega projects, dams, ports, highways, power plants. Because if policy reform could be debated, concrete felt undeniable. But concrete, as we're about to see, doesn't just build. Sometimes it buries. In the next section, we go inside the era of bulldozer diplomacy where development met displacement. If the 1980s were about rewriting economies, the decades that followed were about reshaping landscapes. Because when macroeconomic reform becomes politically toxic, there is always another lever to pull. Infrastructure, dams, highways, ports, power plants. Concrete is seductive. It is visible, it photographs well. It creates the impression of momentum. A minister can stand in front of a ribbon and say, "We built this." And for decades, the World Bank operated on a philosophy that seemed brutally logical. Big poverty requires big infrastructure. You cannot industrialize without electricity. You cannot trade without ports. You cannot integrate rural farmers without roads. And that logic is not wrong. Every country that is rich today industrialized on the back of massive infrastructure expansion. The United States built the Hoover Dam. China built the Three Gorges Dam. Europe industrialized by laying railways across its continent. Development is physical. But the moral equation becomes complicated when the cost of development is borne by those with the least power to resist. One of the most infamous examples is the Sardar Sarovar Dam on the Narmada River in India. In the mid-1980s, the World Bank approved hundreds of millions of dollars to support the construction of this massive hydroelectric project. On paper, it promised irrigation for millions of hectares, drinking water for tens of millions, and electricity for a rapidly modernizing India. In a spreadsheet, it was transformative. In the valley, it was devastating. The reservoir would submerge hundreds of villages. Entire tribal communities at Avasis would lose ancestral land. Tens, perhaps hundreds of thousands of people would be displaced. The bank had resettlement policies on paper, safeguards, guidelines, environmental assessments. But implementation lagged behind ambition. Compensation plans were incomplete. land for relocation was insufficient. Social realities were treated like variables in a model. Protests erupted. International activists amplified local voices. For years, the bank resisted criticism. The project had been approved. Funds had been allocated. Institutional momentum had taken over. And this is where we confront a structural problem inside development institutions: the pressure to lend. Within large multilateral banks, career incentives often reward disbursement, moving money out the door more than long-term social outcomes. If you stop a massive project due to social concerns, you are seen as an obstacle. If you push it forward, you are seen as productive. The Sardar Sarovar controversy became so intense that in 1991, the World Bank commissioned an independent review, the Morse Commission. The report was damning. It concluded that the bank had violated its own policies on resettlement and environmental protection. In 1993, under immense pressure, the World Bank withdrew from the project, though India continued it independently. This moment was historic. It forced the bank to confront a brutal truth: development cannot be reduced to megawatts and cubic meters. Human beings are not relocation statistics. And yet, the dilemma never truly disappears. Because here is the counterargument, one that policymakers in poor countries articulate with justified frustration. Without infrastructure, poverty becomes permanent. You cannot refrigerate vaccines without electricity. You cannot transport crops without roads. You cannot power hospitals with intention. If the World Bank becomes too cautious, too slow, too procedural, another lender will step in, and that lender may ask fewer questions. After the Narmada controversy, the World Bank strengthened safeguard policies. Environmental impact assessments grew more complex. Social protections expanded. Gender plans, indigenous peoples frameworks, compliance audits all layered into the process. Approvals slowed. Projects became bureaucratically heavy. Meanwhile, a new actor was rising: China. Through the Belt and Road Initiative, China offered rapid financing for infrastructure, often with fewer political conditions and faster timelines. For a finance minister facing elections in 12 months, speed matters. So the World Bank found itself in a bind. If it insists on perfect safeguards, it risks irrelevance. If it relaxes them, it risks repeating past harms. This tension remains unresolved, because development from above always carries the same flaw. The decision-makers rarely live inside the consequences. An economist in Washington may design a cost-benefit analysis. A bondholder in Frankfurt may evaluate credit risk, but the farmer whose land is flooded does not attend those meetings. And when development is treated like a large-scale engineering problem, the social complexity becomes an externality. The bank learned lessons from bulldozer diplomacy. It shifted more attention toward health, education, and poverty reduction programs. It built internal accountability units. But the scars of mega-project controversies linger. And beneath them lies a deeper, darker issue. Because not all failures come from bad engineering or flawed models. Some come from something far more primitive: corruption. Even the most well-designed project collapses if money vanishes before reaching its destination. In the next section, we enter one of the least glamorous but most consequential chapters in the World Bank's history: the corruption conundrum. Because when billions move across fragile states, the leaks are never small. If bulldozer diplomacy revealed the human cost of development from above, corruption exposed something even more corrosive. For decades, the World Bank operated under an uncomfortable silence. Corruption was considered political, and the bank's charter explicitly forbade political interference. So when billions of dollars flowed into authoritarian regimes during the Cold War, and large portions mysteriously evaporated, the official language was sterile. They called it leakage. It was not leakage. It was looting. Take Mobutu Sese Seko in what was then Zaire. Over his decades in power, billions in Western loans and aid flowed into the country, including funds supported by the World Bank. Meanwhile, Mobutu built palaces, flew Concorde jets for shopping trips, and accumulated a personal fortune rivaling the national debt. Why did the money keep coming? A Cold War realpolitik. Mobutu was anti-communist. That made him strategically useful. The United States was the largest shareholder in the World Bank. Geopolitics shaped lending decisions. Development loans became quiet instruments of influence. And in fragile states, money is fungible. Even if a World Bank loan is earmarked for schools, it frees up domestic revenue that can be redirected elsewhere toward military purchases, patronage networks, or political consolidation. You can track the dollars you lend. You cannot control the budget space you create. In 1996, World Bank President James Wolfensohn publicly acknowledged corruption as a cancer. It was a turning point. The bank created investigative units, blacklisted firms, digitized procurement systems, and pushed governance reforms. But the mechanics of corruption are stubborn. Bid rigging, ghost workers, inflated invoices. And the most sobering evidence came from within. A 2020 study by World Bank researchers found correlations between aid disbursements and spikes in offshore bank deposits in tax havens. When aid equivalent to 1% of GDP entered certain countries, offshore deposits increased disproportionately. The implication was stark. Some portion of development finance was being siphoned off before it reached the poor. And yet, the bank faces a moral trap. If it stops lending to corrupt governments, who suffers? The dictator? Or the children who lose access to vaccines, clean water, and schools? Engagement risks fueling corruption. Withdrawal risks, abandonment. There is no clean choice. And now, layered on top of corruption, infrastructure dilemmas, and macroeconomic scars, comes the defining issue of the 21st century: climate change. The World Bank's original mission was reconstruction. Its second mission was poverty reduction. Its third mission is planetary survival. And this is where the contradictions reach their peak. Imagine you are the energy minister of a rapidly growing African country. Half your population has no reliable electricity. Hospitals run on generators. Children study by candlelight. Under your soil lies coal, cheap, abundant, reliable. You approach the World Bank for financing to build a coal power plant. The answer, since 2013, is almost certainly no. Under pressure from major shareholders, the bank largely ended financing for new coal projects and scaled back fossil fuel support. The moral argument is clear. Burning coal accelerates climate change. But here's the paradox. The rich countries built their wealth on fossil fuels for 150 years. Now they tell poor countries to leapfrog directly to renewables, solar, wind, battery storage technologies that are cleaner but often more expensive and technically complex. Critics call this green colonialism. The rich polluted their way to prosperity. The poor are told to borrow money to buy green technology, often from companies in the very countries that industrialized first. To respond, the World Bank has embraced green bonds. It pioneered the green bond market in 2008, raising capital earmarked specifically for climate-related projects. Pension funds and ESG investors buy these bonds to signal environmental responsibility. The bank lends the money to fund solar plants, flood defenses, and resilience programs. But the transition is messy. Consider South Africa. Its economy depends heavily on coal. Coal mining employs tens of thousands. Shutting down coal plants requires not just building renewables, but retraining workers, restructuring industries, stabilizing grids. The just transition requires funding. Much of that funding is structured as loans, so South Africa must borrow money to shut down its own domestic industry. Climate finance becomes another layer of debt. And this highlights the core tension. The World Bank is now expected to solve global public goods problems: climate, pandemics, biodiversity. But it was designed primarily as a development lender. Its balance sheet is not infinite. Its shareholders demand climate action, but are reluctant to inject massive new capital. They want Ferrari performance with Honda funding. And while the bank wrestles with climate, something else has changed. For 70 years, the World Bank was the only major multilateral development lender. If you were a developing country and needed infrastructure financing, you called Washington. That monopoly is gone. In 2014, the BRICS nations launched the New Development Bank. China spearheaded the Asian Infrastructure Investment Bank. Suddenly, finance ministers had options. Option A: the World Bank with environmental safeguards, governance conditions, and long approval timelines. Option B: Chinese financing, fast, infrastructure-focused, fewer political strings. Competition changes behavior. The World Bank must streamline processes, leverage its balance sheet more aggressively, and compete. But it cannot fully abandon standards without losing support from Western democracies. So the global financial landscape is becoming bipolar. Countries will mix funding sources. Soft social projects from the World Bank, hard infrastructure from China. The era of Western monopoly is over. And that leaves the World Bank in an identity crisis. Is it a bank, a charity, a climate institution, a geopolitical instrument? It is 80 years old. Its original mission rebuild Europe is complete. Its poverty reduction mission is harder as progress stalls in fragile states. Its climate mission is underfunded. It is trying to do more with the same capital. Recent reviews suggest it could leverage its balance sheet more aggressively. President Ajay Banga has proposed reform streamlining approvals, mobilizing private capital, expanding crisis response tools. But structural limits remain. The World Bank is ultimately a mirror of the global order. It reflects who holds capital. It reflects geopolitical power. It reflects the moral compromises of wealthy nations. It has helped lift millions from poverty. It has funded vaccination campaigns, education initiatives, infrastructure networks. It has also supported flawed policies, tolerated corruption, displaced communities, and enforced austerity. It is neither hero nor villain. It is a machine built by imperfect governments to manage an unequal world. And until we invent a system where rich countries transfer wealth without expecting repayment or influence a scenario that remains politically unlikely, the World Bank remains the primary messy tool we have. The real question is not whether the World Bank is good or bad. The question is whether it can evolve fast enough to remain relevant in a multipolar world facing climate breakdown, debt crises, and geopolitical fragmentation. Because if it fails to evolve, it won't collapse dramatically. It will simply fade, replaced by institutions that reflect new power centers. And development finance will continue. Just under different flags. That is how the World Bank actually works. Not as a benevolent savior. Not as a secret cabal. But as a financial instrument balancing poverty, power, markets, and morality, one bond issuance at a time.